limited partner in that apartment complex. A limited partner, films are done this way. Like somebody's making a Hollywood movie, they'll have limited partners that will invest in that. Now, the advantage of this, rather than like a private placement stock, is that with these partnerships, they have a flow through of income and certain expenses. And so, for example, in a lot of these businesses are not profitable in the first several years, right? A good example of this is people that invest in mining operations, looking for oil wells, I guess, right? And so if the company is striking dry holes and not hitting, an oil well, then they have drilling costs and expenses and et cetera, and those losses are passed through to the limited partners who can then take it off their taxes against other income. And then, of course, when they hit that big gusher and become profitable, then they'll get a share of the profits. Now, generally, these private placements are limited to small amount of limited partners who must be accredited investors. Remember the numbers for accredited investors: either $1 million net worth, $200,000 income, or $300,000 as a couple. The $1 million is excluding your primary residence, and they can be public, but that would be rare. Now, generally, they're liquidated on a predetermined date. They're designed to be liquidated so that the limited partners get paid out. And the accounts are settled when they close it out in this order: secured lenders, other creditors, limited partners, and then finally the general partners. Okay?
So, I'm so sorry, really quick. Is it saying to be an accredited investor, they need to have one of these three things?
Correct.
Okay.
You don't remember the thing with accredited investors?
Honestly, I forgot.
Yeah, that's a big thing on the test. You got to know that. So there's certain things like private placements or things like that. Because remember, the whole idea of this, all these rules, are to protect the little investor, right? And so, like the stock market crash of 1929, right, affected the small investors. People were jumping out windows and all kind of stuff like that because they've lost everything. Okay. Now, the idea is this, right? They call them the capital markets because that's where corporations and businesses go to raise capital. So just like on Shark Tank, which we did talk about, right? So on Shark Tank, they go on Shark Tank to what? Raise money for their business. Well, unfortunately, there's not enough sharks to fund all the businesses out there that want to raise money. And so we need all these small investors. And in order to get small investors to feel comfortable in putting their life savings, their retirement savings, or the money that's important to them into the capital markets, we have to keep the markets fair, free, and not a place where people go and get ripped off and have their money stolen away from them. You with me? Right? It can't be like the wild, wild west like crypto is right now. There's got to be some regulations and controls to keep, people from doing bad things. So that's why we have all these rules. But we don't particularly need to have these rules for the rich people. So basically the rich people and institutional investors and accredited investors, the rules are off for them. So you'll notice that there's a lot of things like, once again, these limited partnerships or private placements that are only available to accredited investors.
Yeah. Okay. Thank you. It came back to me. I appreciate it.
Right. And the numbers are $1 million, excluding your home, $200,000 income as a person, or $300,000 as a couple. One of those three makes you an accredited investor. Now, also for test purposes, once you become licensed, once you pass your Series 6, or if you are an institutional investor, you are, by definition, a accredited investor as well. So you don't have to meet the $1 million or things like that, because the idea, once again, is you're educated, you're knowledgeable. So we're trying to protect the little person from getting ripped off, but accredited investors, and once you get your license, you should be knowledgeable enough that you wouldn't be taken advantage of by some unscrupulous person.
Okay.
Make sense? All right. Continuing on. So in a general partnership, there are only general partners. And what it's talking about is this. If you talk about a general partner, that's where, like, you and I form a partnership. We're going to have a partnership agreement, and there's only general partners. There's no investors. In a limited partnerships, you have general partners that are running the business, and then you have the limited partners that are the investors. And you got to kind of keep those separate. So, for example, when they're talking about registering an account, right? You have a sole proprietor, you have a general partnership, 2 people and no investors, and then you have a corporation. And that's what they mean by a general partner. Remember that?
Yeah.
Okay, so just keep those separate in your head. Okay? All right, now, once again, the big advantage is, unlike any of the other investments, like REITs or mutual funds, the losses are not passed through. But with the direct participation programs, limited partnerships, the losses are passed through, including depreciation and depletion. Now, what's depletion? Well, we talked about the oil wells. So loss of value is the depreciation, which means the equipment gets older and we're going to depreciate the value of it. Depletion is the loss of value for resources that are used up, lumber, oil, natural gas. So as those resources are used up, you're going to get a tax deduction for what's called depletion.